Hi, Simona.
Hi, who's that?
Michelle.
Hello, how are you?
Yeah, good.
Can you guys see the screen?
Yep.
Cool. Now you don't have to obviously turn your video on. You can if you want. Yeah, I'll leave this as quite an open session. So yeah, if you want to jump in and talk or you want to participate, then go ahead. Because it's not so much me talking too much, but it's more about going through it together. So did everyone open the Excel file?
I opened and then thought I'll wait till you walk us through.
Yeah. Yeah. So it's just to be used as a base. So it's a really kind of simple template, just to get people started to think about their cash flow. So I think I know some of you I don't know. But yeah, look, welcome. This is sort of sponsored by the Chamber to try and get businesses thinking about their cash flow, because a lot of people have run out of cash, and also they're looking at ways to sort of look at what are they going to do when they are going to run out of cash. So I'm sure every business is affected at the moment, and that's what we're trying to help people with. There was a survey that was done by I think the WA Chamber of Commerce, and something like 80% of the businesses said that they were struggling with cash flow and they didn't really understand what cash was coming in and how they would manage it. And obviously with the downturn, with income going down, I think that's the main anxiety that business owners are actually facing. So this is like an intro session. We're going to be doing more actual hands-on cash flow sessions, and maybe when things go back to normal and we can do face-to-face, we'll try and organise stuff like that as well. So just as a show of hands, or if you want to say yay or nay, who here is finding cash flow forecasting or trying to work out if they've got enough money? Who's finding it tricky?
Yeah, it's a balance.
Yeah. And even for I'll turn on the chat actually. Yeah, and even for firms like ours, I mean, we're really busy at the moment, but it doesn't always mean we're going to get paid, because a lot of businesses don't have the money to pay us. So we do know that we're a little bit unsure of our own cash flow as well. And look, my husband runs a business as well, and he's in the same boat. His income has dried up quite a lot. He's getting nervous about, how he's going to keep the business going. So I want to touch on some of the relief packages that the government has issued, which will hopefully help a lot of businesses as well. So from a cash flow forecasting point of view, how many of you actually look at this and maybe write it on a piece of paper or on a whiteboard? Or is it all in your head? Do you sort of know roughly what's coming in and what's going out? We get some feedback.
I know I do a bit of forecasting.
Yeah.
In Excel. Yep.
Yeah, good. And how about everyone else? Do you think you know what's going on?
Well, before coronavirus, it was easier. I think I question whether many of my clients will be able to pay me till after.
Yeah.
That's my industry.
Yeah, that is a real threat to service-based businesses for sure.
Yeah.
And I guess with the businesses that have staff, how are you looking at the projections? Are you keeping your staff? Have you reduced their hours? Is that overhead sort of causing you concern at the moment?
Yeah.
Yeah.
Yeah, we've had to let staff go and reduce hours.
Yeah. And this is a reality across the board. Everyone is suffering. There are a few pockets of industries where they're actually booming and they're doing really well. But on the whole, everyone is suffering with cash flow problems. I think the biggest issue recently has been that the BAS for March is due now. And obviously the cash flow boost is a credit that people get back. But it doesn't always mean that people get cash in their hand. So I think a lot of businesses were hoping they'd get like 50K come in, and then it would fix all their problems. And actually they're not actually getting any cash back from the government yet. So that's the first thing that has really sort of stressed people out. And then the second is the JobKeeper, because it's still got staff, still got to pay their wages, trying to, work out how you're going to get paid from the government for the JobKeeper is still it has been quite uncertain for most people. So I don't want to drone on for too long about, the nitty gritty. I want to give you an overview of cash coming in and cash going out and the main principles. Some of this might be really easy to use. Some of it might not be, but I'll try and be quick. And then we'll go through and maybe look at a live example of how, a business might look at their projections. So what I might do is share my screen. And I'll quickly talk through just the main cash in and cash out. Sorry, I just have to move bits around on my screen. Rightio, so cash coming in. This is where people come unstuck, because you might have invoices you've issued to people. You might be doing work for cash. You might be a food outlet or a retail outlet, and you're taking FPOS and cash. It's hard to work out how much money is going to come in. And I guess you can look at the history, and you can try and roughly forecast how many customers you're going to have and how much money coming in. I think the biggest thing there with cash coming in is if you've got invoices you've issued, do you know when those customers are going to pay you? And do you have a system to work that out, in the sense that, have you sent the invoice? Does it have a due date? Have you followed up if anyone has, if anyone is overdue? What are you going to do when people start not paying you? Are you asking them for payment plans? Are you, looking at ways to still support them, but not have to get stuck with not getting paid? All of those things. So, money coming in from customers is the biggest unknown at the moment. And I think what we've done with this Excel template is we've said, we'll give you a base case to work out roughly what you think. And then there's a couple of scenarios that you can run to see if income actually is only half of what you're expecting, what does that do to your cash flow? So from a bigger business point of view, the bigger companies at the moment are doing scenario testing. So they're going, okay, we think we might be down 30%, but what happens if we're down 50%? Does that mean we're completely underwater? We've got no money left? And those are the kind of decisions that you probably need to make at some point if it gets to, if it gets really, really bad. So there is a balance between sort of estimating what your cash might be based on what you know now, and then, maybe a better case scenario and a worst case scenario. And it's knowing what those best case and worst case look like, so that you can maybe, if you're going towards the worst case, you can then try and do something before you run out of cash. And that's kind of the point of a cash flow forecast. So at what point do you run out? So we'll go through a live example with the income coming in. There's obviously other cash injections that can come in. So, in our forecast, we've got a few areas to put figures in. One is from the customers. Another one might be other income that you can have coming in that's non-operating. You might be selling assets. You might get to the point where you think, well, I'm not using these assets. I need some cash. I'm going to sell them. That money comes in. So that's sort of not operating, but it's still going to help fuel the business. And then the final one is other cash injections. You might have to go to the bank and ask for money. So, or you might have to borrow from another business, or, from family and friends, whatever the scenario is, there are other ways to inject cash into a business. So they're the three main ways you can get cash in, from customers, from selling assets or selling shares, for example, if you're a bigger business. And the third one is from other sources, so the owners or the bank. So that's cash coming in. Now, cash coming out is also quite tricky, I think, for most businesses that we deal with, because of the interplay with GST and tax. So the first one is net wages. Now, if you've got staff, you know roughly what you're paying them in wages, but when you go to pay them through the payroll, you're taking tax out. So you're paying the net amount to the staff. And look, we've had many scenarios where businesses, especially newer businesses, they forget that actually the tax is taken out and they forget to put that aside. And then when it comes to the quarter end, to the BAS, they don't have the money. And this is actually a common problem. So with one of the ways that we sort of strategize with businesses is we say, look, try and put the tax and the superannuation aside, and your GST if you can, every time you run a payroll. So if you're paying your staff every fortnight or every month, you know, your system will tell you what the gross wages are. Work out what the tax is that has been taken out, and put that money aside somewhere else, because it's not your money. And you don't want that money to be sat in your bank account and confuse you, because you look at your banking account and go, oh, well, I've actually got loads of money. But you don't, because it's actually not your money. So when you're doing a forecast, you should be including the net wages, not the gross wages. Sorry, 1 second, I'm just checking my... And so that's net wages. Now, a lot of people say, well, how do I work out what the net wages is? Roughly 80%. If you want a figure to roughly work it out, just use 80%. It's not perfectly correct for every business, but on the whole, it's probably about right. So if you're paying someone 100,000 in salary, you're probably paying them net, say 80 grand, because 20K comes out as tax. All right, the next one, accounts payable. You might be in a situation now where you have some money in the bank, but your bills are piling up. So people owe you money, and sorry, you owe people money. So you need to know how much that is. How are you going to pay all those bills is the other thing. So having a look at those bills and working out, can you defer any of them? So things like synergy bills, rates and taxes, you can actually defer all those at the moment. So have a list of what you owe, and start putting some dates next to those items and saying, well, actually, I'm not going to pay that for 6 months because I'm actually allowed to defer it. Other things you might have, you might have had your suppliers provide you with goods and services. Now, they want to be paid as well. So you might need to engage in discussions with them to see, you know, how you can maybe pay them over installments, or, you know, have some sort of payment plan in place to pay them as well. Because a lot of those bills are probably building up, and they don't look like they're going to impact you now, but eventually they will, because it's going to be a big hole in your cash flow later on. So tracking that is quite important. And the quickest way we do that with clients is we go into their accounting system, we look at accounts payable, which is their bills to pay, we export it to Excel, and we go down the list and we prioritize and say, yep, these ones have to be paid, these ones we can defer, these ones are on a payment plan. And then we put that in our cash flow and say, well, no, there's stuff that's non-negotiable, we have to pay, and the rest we will try and manage over the next few months. Now, the next item is cost of sales. Now, if you understand how a business works, you've got direct costs that relate to selling. So you've got direct costs like products, if you're selling products, or if you're a service-based business, you might have contractors or, you know, other sort of delivery costs or whatever it is. Cost of sales is dependent on your sales. So if your income goes up, your cost of sales will go up, because if you're selling more, you've got to buy more product. If you're a bakery, for example, you need to have the raw materials to make the bread. So the more sales you have, the more flour you got to buy, in simple terms. So the cost of sales is usually a percentage. You can work it out roughly as a percentage of income. And what that means, it's a variable cost. It's not fixed. It's one of the harder ones to forecast, because obviously when you're buying stock in, you've got to buy a big chunk of stock sometimes, and it kind of skews your cash flow because you need a lot of money up front to buy the stock to then sell it. So that line there would be probably the hardest to forecast, but again, you can use some percentages. Operating expenses, overheads, these are your fixed costs. So anything that's you can't not pay, your rent, your electricity, your insurance, all of that sort of stuff. So I'm just trying to admit some more people in. Hopefully I haven't missed anyone. Yeah, no, that's fine. So that's operating expenses, so overheads. Now, generally with overheads, you need to make enough gross margin to pay your overheads. So a quick way to work out how much your turnover is, well, the minimum turnover you need, is you take your overheads, you divide it by your gross profit margin, and that is your turnover target. If you're not making that turnover target, you are underwater. You have no money, you will run out of money very fast. So understanding that balance is quite important. You're going to have a dip this year with cash flow, and yeah, everyone is, but there comes a point where there's no way out in a way, you know, when your income does drop so low that your debt and your bills pile up, and it will take you so long to recover that sometimes, you know, it's so insurmountable. So you need to know what those overheads are. For some businesses, there's not many overheads. For others, it's actually quite substantial. If you've got rent and bills, you should be trying to reduce your rent at the moment. So speak to your landlords, get some rent abatement in place, or if you've got mortgages, stop your payments on your mortgages to try and reduce that cost, because those fixed overheads are really going to impact your cash flow in the future. The next one is asset purchases. It's a cash outflow because if you need to buy assets, you need to find the money to pay for them. And you know, you might not need them now, but a car might break down or a piece of equipment might break down and you need to find the money to pay for it. And yeah, you can get debt to pay for it, but not always. So that's something to maybe look at in your business. You know, what assets do you need to replace, and how much money do you need to keep things going, keep the business going. Loan repayments is another one. People miss this all the time. We do cash flow forecasts for banking, for financing. So when business owners are trying to get money from the bank or they're trying to buy another business, they tend to forget. Sorry, I'm just admitting someone else. They tend to forget that they've got loan repayments. And every month they end up with no money in the bank, and they go, well, why have I got no money? Like, I'm making money, where's it all gone? And then when we look at their, you know, their bank statements, or we look at their zero files, 9 times out of 10, it's because they got debt and they forgot to factor that in. So if you've got cars on finance, if you've got debt repayment plans with the ATO, if you're, you know, you've got an overdraft, whatever it is, make sure those repayments are included, because that's how you end up with no money. And know what that payment schedule is, because it's sometimes it's 5 years for a loan for a car, for example. So that's loan repayments. The next one is the ATO. At the moment, we're telling everyone, if you've got an ATO debt, put it on hold. Don't pay the ATO. They're fine with it. You just ring them up and you say, look, I want to defer the payment, because the point is you need to keep cash in your business. So if you're lodging your March BAS at the moment and it's an amount that you've got to pay, really consider getting a payment plan for that debt, because you never know, you might need that cash over the next few months. So I'm kind of assuming for most businesses there's no payment to the ATO, but remember, as we come back out of this, you will have to pay the ATO later. So always remember to put those figures in as well for your cash flow forecast, because it is still a debt. Another one is superannuation. Most of the time it's paid quarterly. Again, people forget about it. And then it gets to the quarter and they don't have the cash. So like I mentioned before, try and put that money aside every fortnight or every month, so at least you know it's parked and it's not yours to spend. If you're really short on cash and you need to use all your cash reserves, that's fine, as long as you remember that when the quarter comes, you've got to find that money. And superannuation is one of the ones that you can't not pay. If you don't pay your superannuation for your staff on time by the 28th of every month following the quarter, you can't claim it as a tax deduction, right? So not only do you get slumped with interest sometimes on the late payment, you lose the tax deduction, and it's quite a lot of money that you're losing. So it's probably one of the ones that you really do need to factor in as a critical. They're not giving any relief in terms of superannuation. The tax office is giving relief in terms of GST and everything else, but not superannuation. So just remember, 9.5% of wages has to be put aside to pay that. The next one is payroll tax. This doesn't apply to that many businesses, because you need to have a payroll of roughly $1 million a year to be paying payroll tax. But it's another one that businesses get caught out, because you've got to pay it on time, 7 days after the month end, and it's usually a lot of money. So I won't touch on that too much, because most small businesses don't have to pay it, but yeah, some do. And then the last one is other. So there's other stuff that comes out of your bank account that you need to know about. Are you paying for your personal living expenses out of your business bank account? If you are, then how are you controlling that? You might be better off just taking some money out every week, a fixed amount, into your personal account and managing it that way. Otherwise, it just all gets washed in, and you have no clue, you know, what you're spending. Another one is taking drawings, because not all owners get paid a wage. So they're taking drawings out of the business, which is fine, but you need to factor that in, because you still need to live. So just think of the business as a separate entity, and that entity pays you as and when it has money, because as you run out of money, you might not have any left. So anyway, that's cash in and cash out in a very simplistic manner. So do we want to ask any questions? Does anyone have any questions about any of those main categories before we sort of start looking at an example? You have to unmute yourselves, by the way, if you want to ask, or just put it into the comment section as well, if you've got any questions. Well, maybe we'll just dive in and have a look at how we might do a cash flow and do some scenarios to see how the cash moves. I'll share the screen again, and maybe we'll get started. And I won't take too long. I just want to show you roughly what I would do if I was doing a cash flow for a business. So in this case, I'm going to start with the month of April, because we're in the month of April. I'm going to pretend I've got 15,000 in the bank account at the start of the month. I then need to somehow forecast what my income is going to be for the next few months. Let's say on average, we've been doing 10,000 a month roughly in income, but this is a bad month, so I'm going to put 8,000 in. Next month, maybe it'll be 7,000, and maybe it's going to drop for a little while. So I'm just going to roughly estimate some figures in there. And then, I mean, I can just put a figure here for the rest of the month, and it just populates. So again, you can just come in here and just change the income figures at any time. This is the GST inclusive value, by the way. So when you're doing cash flow, you have to include GST. All right, so next I'm going to look at any other sources of income. Well, you know, I might sell something. I've got a bit of equipment. I don't need it anymore. So maybe I'm just going to sell that and maybe make 10 grand next month, because I need the cash. You can add any other items in here, rental income, interest, etc. But yeah, most businesses wouldn't have that. Most of the time they'd get money from selling assets. At the moment, I'm not going to put any money in, but if I was to put some money in, I'd maybe put some figures in here for contribution by owners, but let's just leave it for now, just so we can see what the cash flow might look like. I'm then going to have an employee who, let's say they get paid $25,000 a year. So their net wages is just under $2,000 a month. Let's say I've got another employee that's on $50,000 a year. So I've put their wages in and it just calculates for you. So if you go into the front sheet and you select, you know, the date you want this to start, you go to the payroll section and you say, okay, I pay my staff fortnightly, and, you know, a pay period started on this date, then the forecast will calculate, you know, roughly how much you need to pay in wages. So I've put them in there. Next, I'm going to have a look at what I owe. I'm just going to say I've got a big supplier that, you know, I need to pay. And maybe I'm on a payment plan to pay him, I don't know, $1,000 for the next 4 months because I just don't have the money now to pay. Next section, I'm going to look at the cost of sales. In my business, you know, at the moment, my stock is costing me, I've put in there 20%, let's say it's 30%. On average, you'll know roughly how much you're marking up your product or your services, and you'll have a direct cost of sale component. Just estimate it for now. You'll be able to go back into your records and roughly work out how much you're spending on your stock or your product, and just roughly guesstimate the percentage. It doesn't need to be perfect, but it just gives you an indication of, you know, roughly how much you're going to be spending as cost of sales. All right, and as you can see up here, this closing balance is telling me what my bank balance might be in the next few months based on what I've just put in there. And it looks like I'm running out of cash in October already. So then we go to the next bit and we say, right, well, I do have to pay rent of $1,000 a month. And let's say my landlord agreed that I don't pay rent for 3 months. So I'm just going to make them zero because he's given me a bit of relief. I've got insurance of $150 I've got to pay a month. I can't get out of that because I still got to pay it. I've got some office expenses. I'll say it's $50 a month. I've got some subscriptions for my you know, software that I use, and let's say that's $100 a month. You can't really get away with not paying subscriptions at the moment, especially if you're using tech in your business. So I've put you know, a rough estimate of that as well. This is kind of the bare bones. Your business would have, you know, a different balance of overheads. And these are the main categories we use. You can add your own category, but just generally that's what we use, because it gives us a rough idea of you know, what are the main things we're spending in the business, and you can look back and you can see exactly what, you know, what you've spent on, say, insurance or occupancy, and maybe just, yeah, put a ballpark monthly figure. Or if you know that you pay, I don't know, $2,000 in insurance in July, then put that in, because sometimes you're not on a monthly payment plan for insurance. So just for now, that I've just put those figures in just to see what happens. I'm not going to buy any assets because I'm trying not to spend money, so I'm not going to put anything in there. But let's say I get to the point where my car needs to be replaced, I might put a figure in the vehicles at some point. And that's GST inclusive as well, the value of the vehicle. Let's say I've already got a car and I'm already paying $500 a month for that loan. So I'm going to put that in there to show that I'm still stuck with that loan and I still have to keep paying it. As you can see up here, I'm running out of cash in August. Then we get to the ATO section, and this is, it is a bit of a tricky section, but the figures are there to calculate roughly for you what your GST payable and credit might be and how much you need to pay the ATO for your PAYG. So it calculates it for you. So let's say your wages, if we go back up here, the wage bill for the month of April is $4,600, and that's after tax has been taken out, and then the tax bit is here, so $1,100. So the figures are there for you to calculate. You may not pay the ATO yet because you can get a payment plan, but it's there for you to know roughly what that debt might be. You may get a cash flow boost credit. What that means is that the ATO is crediting you the tax that you would normally pay. So you can say that actually I'm not paying that PAYG until September because the government is paying for that at the moment. So I'm just going to put that as a negative to say I'm not paying that. And then roughly it's worked out what my GST is. Let's say that I'm entitled to the JobKeeper and I've got 2 staff plus myself that I'm going to be claiming for. The money starts coming in May. I'm going to say, well, actually, I'm going to get $1,500 back per fortnight for 3 people. And I'm going to get that until October because it's for 6 months. So I'm putting that money in there to show that I'm eligible and that money is going to come in. And remember, it doesn't start till May and it goes all the way up until October. So already you can see that I was running out of cash in August, but because the government is paying me the JobKeeper, I'm actually okay. I'm actually going to have 50K in the bank account by October. The rest of the stuff, there's no payroll tax. I need to live. So I need roughly $5,000 a month to live on because I've got kids and I've got to still pay the bills. So I'm going to take out $5,000 and that's why it's coming under drawings by owners. So that's really a very quick cash flow forecast and it's taken, what, 10 minutes? It might take you a bit longer because you've got to roughly work out what your overheads are. But this will give you a very quick summary of you started with 15,000, you might run out of cash by December and really you're surviving because the government is paying you the JobKeeper. So what we do then is we then go to this page and it shows us the cash is fine and then it dives in December. Then what we might do is we go to another scenario, and I'm going to say that actually the income I just forecasted, it might not be that great. It might drop by a further 30%. So I've gone negative 30% for the income there. And I've said, look, I'm going to drop wages as well because my staff aren't actually going to be working that much. So I'm going to drop that as well. I'm going to drop some of my overheads because I need to. And then this is the outcome that happens. So let's say my income drops by 40%. The figures update themselves, and you can see the drop in the bank balance. So anything you adjust in this scenario is it just uses the income and expenses from the base case, and it just adjusts just so you can see what might happen if your projection is actually not bang on the money. In this scenario, I've assumed that no payment is coming in from the ATO, but I might just go, no, I'm assuming that the JobKeeper is coming in. So there's no adjustment to the ATO, so that money is coming in. There we go, the income and the cash balance jumps back up again. So let's say I'm going to put that I'm not going to get anything from the government, from the ATO. I'm basically going to say what I had projected isn't coming in, so it's negative 100%. I'm in dire straits. I've got no cash. I run out of cash in 2 months. But if I say, no, I'm pretty confident I'm going to get the JobKeeper, I'm actually okay until December. So that's a big difference just by looking at that alone. Then let's look at a second scenario and we say, well, actually, I reckon my income's going to drop by 50%. So in the first scenario, we had a drop of 30%. So in second scenario, I'm going to say 50% drop. And we run out of cash in November. So this is roughly how you would do it. You know, you'd start off with inputting, you know, your income at the top. You'd put all your wages in, you'd put in your overheads, and just roughly estimate it for now. Then have a look at what it looks like, and then start playing around with a further dropping income, or you know, a scenario if you don't get money from the government. What does that then look like? So yeah, that's just a quick demonstration of how the spreadsheet works. I don't think you can break it. If you mess it up, just download a fresh version and start again, I guess. But the point is that you should have some clarity around this, and you should be able to go in here and go, okay, this is my best guess at the moment. I'm going to get some income coming in. I've still got to pay my wages and my bills, but actually the government's going to support me for a while. I'm still going to get money. I'm still going to take money out of the business to live. I'm okay. I'm okay until November, December. So yeah, that's the gist of it. So I think if you've got any questions, please fire away. I might unshare and share this. All right, so Sarah, is it worth going back after a month has finished and putting? Yes, it is worth going back and putting in the actuals. So with that spreadsheet, what you can do is maybe start from, you know, 2 months ago, maybe to say February, March, do the opening bank balance, roughly estimate what money came in and what you spent. Just go through your bank statement. You can quickly see what money came in and then what went out. And then hard code it, as in type the figure in, so there's no formula in there. And then as you go along every single month, just hard code those figures and then continue on the forecast thereafter. Because that opening bank balance will change. You might forecast the bank balance to be, I don't know, 20K next month, and it might only be 10. So you've got to adjust it again. But you can put whatever figures you want in there to make sure that you're still tracking your income and expenses. So that is a good point. There are more sophisticated ways of doing this. So when we do cash flow forecasts, and we do them nearly every week for some bigger clients, we use systems to download the data. It gets dumped into a template, and we have formulas that take that actual data and reforecast it out. So there are more sophisticated ways of doing it, but this is just a very quick way of getting a snapshot of where your cash is coming in and going back out. And really have a look to see if you are eligible for the JobKeeper and the cash flow boost, and put those figures in, because they literally will mean you survive, because your income is going to be quite low and you'll run out of cash pretty fast otherwise. So yeah, are there any other questions about cash flow in general? I did mention on the post about a cash war chest. So what that means is a lot of businesses are actually, they strategically put aside profit into a separate bank account. And this is one of the strategies we use with larger clients, where their margins are usually quite low. They're cyclical, income comes in and out, and it's not always so clear what their profit might be. So what we do with them is we say to them, look, every month or every quarter, let's put aside a percentage of your income into a separate bank account. So you can't touch it, as in it's an online saver or something like that. And that money sits there as an emergency fund, because you just never know when you need that. You might be taking drawings, you might be taking a wage from the business, you might think you've got a really good, healthy profit, but you kind of don't know sometimes until the end of the financial year, until, you know, some of the contracts have ended or whatever cycle you're in. So having some money aside can really help. And there are some of our larger clients at the moment who've been keeping that fund going for quite a few years, and they're okay now because they're now dipping into that and using it to keep the business going. So a cash war chest, it basically means it's a forced savings account. You take the money out regularly. It's not yours. You can't touch it. You put it somewhere else where it's really hard to access. Or, you know, you might invest it. You might have it in a short-term deposit or something like that. But the point is, leaving money in your bank account, you're going to spend it. So if you can move money out of the business bank account as regularly as you can, you'll always have something there for you in the future. And also you budget exactly what you need to take out of the business. So you have a personal budget you need to live on, whatever that figure is, only take that money out of the business. 9 times out of 10, when we see businesses collapse or we see businesses in financial difficulty, the number one reason is because the owners have stripped the business dry. They've taken out too much. They use a company credit card for personal stuff. They buy stuff that is not business related. They lose track of what they're spending. So if you can control that, you then know what's left in the bank account in the business is actually relating to your staff and your overheads, and you can manage it better. Whereas if it's a free-for-all, it's just impossible. So yeah, have a separate bank account for your personal, and have a budget, only transfer that out every week or every fortnight. And then keep the business as lean as possible and have a forced savings account set up. And then obviously, you know, in a year or two, you could end up with a bit of money sat in that savings account. And do you know what? You can use that to buy another business, to expand, to do other things. But not having it means that you probably can't do a lot. And you're always on that treadmill of not having any cash. All right, so we've got another question. Can I please check that the formula mentioned it? Okay, so yeah, the formula for the minimum turnover to survive, which is called your break-even point, is your total overheads for the year divided by the gross margin. So the way you work out a gross margin is you say, okay, I've got income, then I've got direct costs relating to that income, and you can use your bookkeeping system because the reports are set up already for this information to be generated. So direct cost relates to product you buy, inventory, consumables, tools, you know, materials, delivery costs, anything that you can directly relate to the sale is called a cost of sales. So you take the income less the cost of sales, you end up with a gross profit. What you do is you take that gross profit and you divide it by the income. I can send this in an actual formula because it's confusing, but gross profit divided by the income gives you the margin. Now that margin is so important. You need to know what that percentage is. And it's different depending on the business and the industry. Service-based businesses, that margin, if you've got staff, is somewhere between 30 and 40%. If you've got, if you're a sole trader and you're in a service business, you're a consultant or it's just you providing services, that margin could be anywhere between 60 and 80% because you've got no staff. If you're retail, as in you're a shop front, selling clothes or selling anything in a shopping centre, your margin is quite low. It could be about 20% at the most. Then it goes down. If you're in the food industry, if you're a restaurateur, a cafe, your gross margin is pretty tight. It could be, say, 15%, which means you don't make much on the products you're selling because you've got wages, you've got consumables, packaging, all of that sort of stuff. So that little gross margin percentage is important to know what it is. So coming back to that formula, take your overheads, divide it by that gross profit margin, and that'll give you your break-even turnover. And if you divide that by 12, let's say, if you're a business that has similar income across all the months, you'll roughly know what the minimum income is that you need to survive. A bit different when you're a cyclical business. I mean, obviously in the Southwest, you've got, the wineries and the restaurants, and their income is quite high in the summer months and then it drops off. And that's why I think a cash flow forecast is important, because you can show that really high amounts in the summer and then it comes back down. But overall for the year, you need to have some sort of understanding of what your break even is. Because put it this way, if you're not hitting your break even, you're wasting your time. You know, you're better off not being in business, because you just get into further debt as a result of it. So yeah, any more questions? You must have loads. When I do this with clients, when I sit there, they have like hundreds of questions with cash flow, because it's just so confusing.
I got one, Simona.
Cool. Yep.
I'm just mucking around putting in your lovely table. I love it. Thank you very much.
No worries.
The cash flow input tab or sheet. I've just entered, say, in stock product purchases and so on, $1,000.
Yep.
Monthly average, but it's coming up with 11,000 in the forecast for April. Is that correct, or is there an error in that cell?
So you've put in 1,000 in the monthly average column.
Yep.
And is there a percentage in the cell next to that?
Yeah, it says 20%.
So you can just put that as 0.
Ah, okay, excellent.
You can do either or. So basically, yeah. Okay. So basically, in there, you know, some people estimate it based on a percentage. You know, like I said, like a restaurant, roughly a third of their sales is the food component. So you can roughly put 30% in there so you know what your food costs are. Or in other industries, it doesn't work quite as simply. So you can just put a figure.
That's fantastic. That just made me break even a lot.
Yeah, right.
Thank you.
No worries. That's all right. So look, yeah, you can even hard code the numbers. Just type over the figures.
That's
you know, and if you mess it up, just start again. You know, because there's not that much you need to input in there. Let's say you put so many hard coded numbers in there, and then you realize you want the formulas back. Go back to the original file, download it again, punch the numbers in, and yeah, hopefully it works.
Yeah.
But yeah, look, that is a component that is really important, that cost of sales, because as I mentioned, your gross margin in some industries, it's just so low that you just don't make much money, you know, generally. And the food industry is one of the ones that there's so many that will collapse, because how do you keep going with the overheads and with this very small margins? Has anyone else had a chance to have a go to see how their cash flow looks? No, you've all got lots of money. No. Is there any confusion around the payroll? So understanding how you work out your wages for, or the net wages, I should say. Obviously, if you've got contractors, it's different, because contractors, you pay them the full amount, including GST. You're not taking tax out. But for wages, there's always tax taken out. Okay, Sarah's asked a question, slightly different question, but can you explain to me the difference between accrual and cash? Yes. Okay, accrual sounds like a weird word, but it just means that you record something when you've done the service or you provided the goods. So let's say, what can I use? Let's say I'm a mechanic, and you know, I've got this big job. So someone's come in and dropped their truck off, and I've got to fix it. I do the work, and it takes me a week to do it. The customer doesn't normally pay a deposit because they want the truck fixed. I then fix it. It's a Friday. I then invoice that client on a Friday. They pick up the truck. I give them the invoice, and on the invoice it says it's 14 days payment terms. When you record that sale in your system on the Friday, that's based on the accrual system because it's the invoice date. I might not get paid for that invoice for another month. Under the cash method, you record that income in the month you get the cash. So there is a disconnect, and it can be quite large, which is why looking at your accounts payable and receivable is actually quite important, because if your accounts receivable balance is really high, it means that people aren't paying you fast enough. There's a really good little metric in Xero. If you're using Xero as your software, there's the business performance section at the top of the dashboard. And in there, you can actually select the number of days people take to pay you. So you can see on average how long it takes for you to get paid. And that's really important, because if you're forecasting and you know on average people are taking 30 days to pay you, if you've issued an invoice today, assume in 30 days you're going to get paid. And obviously not all customers are the same, but you do need to know roughly when people do pay you. A prime example is if you're doing work, let's say you're in the construction industry and you're doing work for a builder, a lot of builders will not pay you before the due date of your invoice, and even then they might put you into the next payment run. So it actually could take 2 to 3 months to get paid. So you need to know that if you're forecasting and saying, well, actually, I've just done a job, I've finished it today, I've paid all my staff, but I'm not actually going to get the money until 3 months later. So that's where the accrual and the cash is quite different. From a cash flow point of view, you have to look at your bank account. So go through your bank account, you can see what's come in and what's gone out, and use that as your base. Your accounting system is probably quite different, because you might look at your cash flow and go, oh yeah, I've had a really good month, and then you look at your profit and loss in Xero and it says that you've done really badly. It's because the invoices were probably issued before, months before. In Xero, you can actually run the profit and loss report on a cash basis as well. So Xero is pretty cool like that. You just run the profit and loss and you click under other options and you select cash. And then in there, you'll be able to quickly see what cash came in and what cash went out every month. So that's probably more relevant to smaller businesses, is the cash in and out. The profit and loss, it's neither here or there, because there's so many adjustments, there's so many estimates. I think as a small business, cash is the way you should be looking at your business. So that is, yeah, it is important. We do bark on about using systems, but remember the systems are only as good as how well you know how to use them. So Xero does have the capability of giving you the cash reporting, so use it.
Mona, I have another question. Sorry. Just regarding that cash and accrual.
Yes.
So we invoice at the end of the month. March wasn't hit that bad, but it was just starting to downturn, and then big drop in April. But the invoices, I suppose the money coming in from a cash perspective is coming in April.
Yep.
Well, how will that impact our JobKeeper application?
Good question.
Because the cash coming in from March was, I suppose, not the 30%, but our invoices for April will be way down.
So good question. So when you do your BASs, do you do it on a cash basis or an accruals basis?
Cash.
So you can choose. So because you're on a cash basis, you can choose either the accrual or the cash method to work out the drop in 30%. What that means is you run both numbers. You look at March and April, and we've got a calculator that you can punch the numbers in, but put in the sales that you invoiced for the month of March and April, then put the cash that's hit the bank account for March and April, and do that for both this year and last year. And if either one of those shows a 30% drop, you're eligible. So you do have, and it sounds creative, but it's not. You're allowed to choose which one is better for you.
Okay. So the accrual will definitely show a drop. So
yeah.
Okay.
Yeah, and look, that's the case with a lot of businesses, because they were still okay in March. They were still invoicing out, and even in particular, the construction industry hasn't been hit yet, because they're still finishing projects. So they're still issuing invoices, and it looks like they're fine, but those projects then end, and then there's zero. So yeah, for a business like that, looking at, you know, you might have invoiced and your profit and loss looks fine, but actually you're going to be pretty badly hit pretty quickly, and the cash is going to show that.
They're assuming that invoices actually get paid.
Well, this is the thing. I mean, how do we know we're all going to get paid? I mean, we're included just as much as everyone else. We're an accounting firm. And, you know, I'm not going to do work for people when they need us. And I guess it's on goodwill. You just hope that people stay alive, their businesses survive. And then at the end of it, everyone can just keep working together. But, you know, in some industries, if you're not getting paid for 2 months and you've got food to buy and you've got children to, you know, look after, that's really hard. And that's why, yeah, the JobKeeper is to keep those businesses going, because they are the hardest hit, the little guys. The big construction companies, they probably have money. They've probably got debt facilities. They've got shareholders to borrow money from. And they can string out all their contractors. They can say, well, actually, we're not going to pay you for 2 months because we're trying to manage our cash flow. And so the poor little contractor, you know, they're ruined because they're not getting the cash. So that's the JobKeeper is there to help those people. And I'm guessing most people would be eligible. You know, most people, I think, have suffered at least a 30% drop in their revenue. Yeah. But yeah, the ATO section of the spreadsheet, I haven't put too many formulas in there because there's so many variables. But just assume that you won't be paying the tax office, and just assume that money's going to come back for the JobKeeper if you think you're eligible. And that little section of the cash flow is going to really dictate how much cash you're going to have. And then, you know what you do? You go back and you go, well, okay, cash is tight. Let's say it's in September, it's looking pretty tight. Then you go back to your overheads and you have a look to see, you know, do I need all these overheads? Do I need all this stuff that I'm paying for? Can you afford to keep all your staff on? Because after September, October, you'd stop getting money from the government and then you got to pay your staff again. And have a look at that, because that's really where the drop off is really going to hit. Yeah. Any more questions? Does everyone know where to go into their bank statements or their systems to find figures? So let's say you've got 2 car loans, but they're being paid for by your husband's credit card or somewhere else, because this is quite common in small businesses. They pay for things on different cards, or, you know, the husband pays for one and the wife pays for it. Do you have that information? You know, go through and see exactly what debt are you paying for. Make sure you put it in, and work out how much you need to live. If you're not paying your mortgages at the moment, if you've got a freeze on your mortgages, then you probably need less to live on. But yeah, you still need to live. So there must be a figure that you need to bring into the household to keep your household going. So yeah, maybe, yeah, have a look at that as well. Maybe drop your wages if your wages are over $1,500 a fortnight. Yeah, look at every single thing relating to the business and your outgoings. And I guess even you could use the spreadsheet for your personal budget as well, because money comes in and then you got to pay money out, and you need to know where that money's going. Yeah. Cool. Well, I'm not sure if there's any more questions. Now's your chance. All right. Do you want to have a chat instead? I think we're going to wrap up soon. So if you want to say anything, just unmute and fire away. Otherwise, I might get going. No worries, Jenny. Yeah, no problem at all. If you do get stuck with the spreadsheet, if something doesn't work, sorry. We do our best to create these spreadsheets. They're not perfect. Like I said, we have our own sophisticated ones that we use that are pretty tried and tested. But when it's a simpler model like that, yeah, it is basic, but it should be enough to help you. So yeah, let us know if something isn't working. Cool. All right. It's bang on 1 hour. So I might get going now. So thanks, everyone. Bye.
Thank you.
No worries. Bye.